Listen, I didn't think that it was possible for Joe Biden and the Federal Reserve to blow it this bad. I really didn't. When Joe Biden was elected in January of 2020, I thought to myself, January 2021, rather, I thought to myself, this should be pretty easy for him. All he has to do is just get out of the way. And instead, he pursued a massive regulatory policy. He blew a bunch of money into the economy. He encouraged the Federal Reserve to keep buying assets. He created a lockdown mentality that led the Federal Reserve to continue to inject money into the economy. And this is the result. And the Biden administration just doesn't know what to do with it. So, for example, Joe Biden is out there just doing happy talk. Yesterday, the president of the United States, he's still bragging about this idea that he is creating a decline in the deficit. He's not creating a decline in the deficit. The national debt in the United States continues to rise at extraordinary rates. What he is talking about is that we are going to have less of a deficit this year than we had last year. That's not a decline in the deficit in any real sense. That's like saying, I outspent my salary by a factor of 2 last month. This month, I only outspent my salary by a factor of 1.5. I'm bringing down the deficit. This is what Joe Biden means, and it's crazy.
After 4 years in a row of increasing deficits before I took office, we're now on a track to see the largest ever decline in the deficit in American history.
So first of all, he doesn't sound like he is he's no longer conscious. When he speaks, he sounds like he is falling asleep, as the rest of us are when he speaks. But if he's delusional enough to believe that he's bringing down the deficit at record rates, he's out of his mind. Again, if you blow out your budget and then you blow it out slightly less this year, you don't get to claim that you're engaged in wild deficit reduction. Pete Buttigieg, meanwhile, who is back from paternity leave, and he left his brain on paternity leave. So I just wish the rest of him would go as well. He says that spending actually reduces the deficit, which is an interesting take.
Some of the investments that we make help with inflation. I mean, that's definitely true with the infrastructure investments, right? Because we know how infrastructure is related to supply chain is related to inflation. It's one of the reasons why, when there was this big fight over whether the infrastructure bill was going to be a problem for inflation, you had a lot of economists saying, actually, this and then the Build Back Better vision, taken together, this is going to ease inflationary pressures.
It's going to ease inflationary pressures, says Pete Buttigieg, who's been amazing at this. By the way, Pete Buttigieg is also acknowledging that despite the fact that he is Secretary of Transportation, we still have a massive supply backlog. So well done there. At least he likes choo-choo trains and finds airports romantic. Again, the fact that he was selected for Secretary of Transportation based on the fact that he couldn't fill potholes in South Bend, Indiana, but he also is gay. I mean, that's his actual resume. It's pretty incredible. Here he is admitting that he is bad at his job.
Just because you see fewer ships off the coast of a place like LA Long Beach, that's not automatically a sign of progress, because there is a new system for queuing that makes more sense environmentally. It's the right thing to do, but I don't want anybody to think that should be confused with solving the issue. That's why what we really count is how many ships are on their way.
Yeah, so good luck to you. Meanwhile, again, the Federal Reserve is kind of stuck here. Stephen Ratner, and all these officials who I'm citing right here are Democratic officials. Larry Summers is a liberal. Larry Summers was the Clinton Treasury Secretary. Now I'm going to cite Stephen Ratner, who's counselor to the Treasury Secretary under Barack Obama. And he writes today in the New York Times, "We were worried about inflation and then Russia invaded Ukraine." He says, while the extraordinarily strict sanctions imposed on Russia constitute an admirable policy response to its appalling invasion of Ukraine, we should not be complacent about the potential boomerang effect on the global economy. The shunning of Russian petroleum has already caused oil prices to jump. Prices of corn and wheat, major exports of both Russia and Ukraine, have been soaring, in the case of wheat, to levels not seen since 2008. That comes as we already endure the highest inflation in 40 years. More inflation means slower growth. On the demand side, the bite of inflation will leave households with less money to spend. On the supply side, already stretched supply lines will be further challenged by repercussions from the war in Ukraine. This week, the Federal Reserve will meet to try to navigate the conflicting challenges of slower growth and rising inflation, a combination that can easily become stagflation. Before Russia invaded Ukraine, our immediate economic problem was inflation. A combination of excessive stimulus from overly large fiscal rescue packages and overly expansive monetary policy and pent-up demand from Americans unable to spend during the pandemic stoked a rush of consumer buying. Facing their own virus-related difficulties, supply lines have been unable to cope with the surge in demand. In addition to the energy and food, Russia and Ukraine supply significant amounts of import materials and components for manufacturing. Roughly 40% of the world's palladium, which is used in catalytic converters in cars, comes from Russia. 70% of the world's neon, central to the production of semiconductors, comes from Ukraine. As we learned during COVID, an inability to source even one small part can hurt a company's ability to manufacture its product. The Federal Reserve, says Stephen Ratner, now faces its most significant policy dilemma since our last bout of inflation 4 decades ago. If the Fed leans toward taming inflation, we face higher interest rates, slower growth, even recession. Holding back on increasing interest rates risks inflation remaining high or even accelerating. The Fed signaled that it will proceed cautiously at its meeting this week. Before the invasion, many inflation warriors, including me, were hoping for a half-point increase to attack rising prices more forcefully. But instead, it looks like they're going to do a quarter-point increase. When it comes to tackling inflation, the Fed is, for all practical purposes, the only game in town. Nonetheless, eager to show engagement, the White House has taken a few small bore steps, like releasing oil from our strategic petroleum reserve and jawboning companies not to raise prices, but these are charades designed to hold up Biden's flagging approval ratings. None holds the prospect of a measurable impact on inflation in the near term, says Stephen Ratner. He says slower growth, weak stock markets, a tougher housing market, stagflation, possibly a recession may be on the horizon. That is the price we must pay for bad fiscal and monetary policies, as well as the meritorious effort to keep Ukraine from Russian domination. So, in other words, prepare for pain. That is the message coming out of the economic wonks these days, particularly the ones who didn't buy into the rose-colored glasses the Biden administration was selling for the first year of the administration. Now, stock futures are gaining because the stock market seems to be invested in the idea that Jerome Powell knows what he's doing, despite the record of the last couple of years. According to the Wall Street Journal, U.S. stock futures gained, bond yields rose ahead of an expected interest rate increase from the Federal Reserve. Technology stocks led to a blistering rebound in Chinese markets after supportive comments from Beijing policymakers. Chinese officials are saying they would coordinate pandemic prevention and control and economic development, keep their economy operating within a reasonable range, and keep the capital market running smoothly, which eased some fears. So Hong Kong's Hang Seng Index soared about 9%, led by gains in technology stocks. Now, how much you wish to trust the Chinese government, I think, is another question at this point, because it's not like they've lied before. I mean, they have. They can pretend that they have not. In a second, we're going to get to how this is all reshifting global financial markets, because I think right now the stock market is a little bit high on its own supply. I think there are a lot of people out there who believe the Russia-Ukraine thing is going to come to a natural terminus. There's not going to be any long-term reshaping of the global supply chains. There's not going to be any long-term reshaping of the global markets. We'll sort of go back to status quo ante, where globalization was the norm. And it seems unlikely over the long haul that that is going to be the case. Maybe in the short term, things go back to something relatively normal. But over the long haul, it looks like we are looking at the reshaping of the world markets in pretty dramatic ways. We're in a battle for the culture and for our values. Like and subscribe to help keep our videos on the front line of the fight and top of your feed.